Hello, everybody. This is February the 12th, 2024. I am John Blank, Zacks Chief Equity Strategist and Economist. And today I'm going to go through two parts of information for you. One, I'm going to close up the Zacks asset allocation by doing a small part three. And then I will move on to our first in a series of sector reviews, top picks from the consumer staples sector. So you can see part one, we'll do Zacks asset allocation part three. Now, part two, three, and four are going to be top picks. So what I want to do this year for a while is just show you top picks, how to find top picks. Obviously, Zacks is a stock picking company, and I want to just focus on giving you really credible information out there for you to use and find it by doing very simple screens. First, on the largest companies, market capitalization in these sectors. Second, by the number of analysts on Wall Street covering the stock. And third, probably most interesting from the Zacks perspective, just the ones that have had the largest percent change in current annual fiscal year one EPS estimates. That's how it's one of the four parts of a Zacks rank to use this particular information that I have put in green here. So it's a nice strategy to show you the big stocks, the best covered stocks, and the ones that have the best forward movement in their earnings estimate on an annual basis. Annual basis is key here. We want that look most of all. That's the one that gets incorporated into the Zacks rank. Whether you knew that or not, now you do. Okay, Zacks asset allocation part three. This is a short piece with just about 3 slides that I want to show you. All right, first of all, let's go back and recap what I taught in part two to you, which is we have in our asset allocation report conservative, moderate, aggressive, and income portfolios that I recommend people look into. Now, what we pointed out is in general, you want to be in an aggressive portfolio for returns, but you also have bigger downsides in these portfolios. As you can see here, aggressive went down 18% in 2022. Income went down 6%. Less overall income over time in a returns perspective, much more income and returns over time with an aggressive approach. However, of course, we got to incorporate these standard deviations right there. You can see it's almost double from these other, or at least 50% higher. You got to suck up volatility if you're going to get higher returns from an asset allocation perspective. No surprise there. Keep that in mind. All right. So over here, in yellow, I have put the amount of aggressive asset allocation. If you took these four portfolios and broke them up four ways, so here would be conservative, moderate, aggressive, and ETF in equal measure, you're going to get this return over the last 5 years. If you put in 40% in aggressive, you're going to get this. 45% aggressive, you're going to get that. Over here, it's a 30, 30, 30, 10 with less income. So cumulative returns over those 5 years, annualized returns here, you can see basically aggressive content was always valuable. In no case, 40, 45, or 30, regardless of the other portfolio weights, did you get a worse return. You got a better return. Standard deviations, as you can see, are not that different. And that is important to understand here. When you go across these, you probably can get away with some aggressive exposure. Now, over here, I found this interesting. This is the ETF income. You can see actually relatively recently in 2023, when the interest rates fell, the income portfolios really did do quite well. So during this period, you've got certain underperformance during the Fed rate hiking and now outperformance. So keep this in mind that we're in a kind of aberrational period as we exit into whatever people are considering this regime for the Fed Reserve. All right, so down here, I've got the portfolio weights again, 20, 10, 10, and these are for 5 stock mutual funds inside the 5 model portfolios. So here's 5 now. We're not 4, we're 5. And here's what we're going to look at: the total stock market index, the Fidelity 500 index, the Vanguard total international stock market index. That'll be the third category here, and that's critical. American Funds Growth Fund will be the fourth, and the fifth will be Strategic Advisors Fidelity's total stock market index. That'll be this fifth column. So as you can see, the third column is international exposure. So here you've got 20% exposure to international stocks. Here you've got 5. Here you've got 0, 0, and 0. So what did best? Basically, over the last 5 years, having is no international exposure. Again, forward looks can change this dramatically, but it does need to be put into mind, like we did before, that aggressive portfolios are better. Here, having less international exposure on a backward-looking basis over the last 5 years was a better thing to do. That can change, but I think it's very relevant to keep in mind. There's a lot of heterodox thinking out there. One of the things that I think is heterodox is not having international stock exposure, but at the end of the day, it paid better to think that way. So don't always pay attention to the canonical views of asset allocation. Number 3, 5 mutual funds and 1 ETF. Now we're going to the Vanguard Total Stock Market Index Fund, a bond fund, a commodity fund, a real estate fund, a US dollar bullish fund, and an international fund. So that'd be 1, 2, 3, 4, and 5. So these are actually 6. I'm sorry, I misspoke. That is 6. Here are the 6 funds. Here are those allocations going across. First and foremost, if you put in money outside of stocks, you get lower cumulative returns over the last 5 years. That sort of should be obvious. 40% allocations here get you 70% returns. 20% allocations to get you 50% returns. Got to own stocks. So allocations across these other ones, generally speaking, this one is your best, which is the 25% weight to the real estate fund. US dollar bullish. Not much of an additional play here, as we talked about international stocks. International stocks, again, keeping it down, not up, was better, generally speaking. So the only thing we can pick up here is there might be some element of benefit to a real estate securities fund in your portfolio. Again, that's on a backward-looking basis, not a forward-looking basis. In the current environment, obviously, we get a lot of concern about commercial real estate. This generally probably isn't good advice going forward. But who knows? Maybe everything's priced in and it rises out of over a wall of worry. Your call on that one as well as mine. All right, let's get on to the top picks for the consumer staples sector. I'm going to go first into market capitalization. Just look at the broad market capitalization. So before we do that, let's review how we're going to do this. This is a 3-part framework for finding top stock picks inside consumer staples or inside any other staples or discretionary or infotech or finance or energy or anything. So first of all, by market capitalization, here are your names. Here are your tickers. So there's the Kenvue, that was a spinoff of Johnson & Johnson. Nestle's in here. L'Oreal is in here. Over in Europe, PepsiCo, Philip Morris, the tobacco group. Unilever in Europe, Mondelez, based in Chicago. All these groups are here. Number of analysts following these stats. More numbers of analysts means more institutional interest. You've got the names. Now, again, of course, sometimes like Estee Lauder and Procter & Gamble are going to be in both situations. So for income investors, value investors, these are kinds of names you're going to find. They're going to be the benchmarks also in big ETF portfolios. So in general, this is what you're going to get out of market capitalization number of analysts, and we'll talk about that first. However, over here, largest percent change in annual earnings estimates going out 12 months. Totally different set of names. Keep this in mind. For example, Elf Beauty, not L'Oreal, right? Elf Beauty is the same business, cosmetics, but it's the one that's growing now. Cody's in here. Again, L'Oreal or Cody. And things like Walden Castle PLC, that's a British company. I have never heard of it. That's the great thing about this ranking. You're going to get names that are doing great. Boston Beer's in here. Karen Holdings, the beverage company over in the Japanese and Asia world. Philip Morris, of course, also here. So, in general, just like I said, I'm going to give you these three ways. And here is the industries that are in consumer staples, by the way. We have five groups that are in there. So we're going to go to the first part first. Top consumer staples by market capitalization. This is the revenue line. This is the earnings forward 12-month line. And here is the free cash flow line. So again, you're just looking for that nice pattern here. PepsiCo is probably an example for the revenues. And of course, they're doing really good with the earnings and are also in a relatively, not so good pace with free cash flow. That's actually P&G. So depending on how you want to go about this, you could pick a good stock. P&G is looking pretty fine from a free cash flow basis. You can clearly see that they manage for that more than the other groups. So a lot of this isn't how these companies manage, but you want to see these things moving up smoothly over time. That's a critical factor, and don't lose sight of that. For example, Unilever, kind of stale, right? Versus P&G. And if it is stale, you're not going to get any returns. By the way, it's an international stock in Europe, and it's part of the reason we talked about that asset allocation earlier. If it's not growing in Europe strong enough, stocks won't do as well either. So return on equity up on this line. Earnings pureness, how much fundamental strength is drawn from actual earnings versus financial gains here. Capital expenditure, if you're going to invest a lot in your business, probably believe in its future. So again, you'd like to see this being pretty high. So again, we like to see good names here. PepsiCo up here again, leading the way. And that is always a good thing to note. All right, depreciation, amortization here, total debt here, and reinvestment rate. I'm going to skip this slide because it's less relevant than the previous two slides, because I want to get to this one, which is the valuations of these shares. Obviously, if you're a value investor, this is the slide that matters most. Here's your forward PEs on 12-month basis. Here's your enterprise value to free cash flow. And here's free cash flow to net income. This is really the interesting place to look. And, there's a lot of stuff, particularly over here. You can see some of these really declined in this 2017, 2018 period. British Tobacco particularly just disappeared. And Mondelez, basically held up pretty well. L'Oreal is, a cosmetic stock, so it gets a higher P multiple in Procter and Gamble. Things like that are important. So keep in mind, this is a nice way to look for value or growth stocks in this consumer staples environment. So that's the first pass, just on market capitalization. Now let's go into the number of analysts covering stock and see who's in here and how they do. First off, I'm going to do DuPont analysis for these companies. Here is the operating margin going from 2009 to 2024. So you want to watch for and see that these operating margins are getting better and improving. That's what you'd like to see out of these stocks. The other place to look for a return on equity. Obviously, you're an equity investor. You'd like to see a good number here. For here, example, STZ is not looking so good. It's a negative ROE. That's not good. Over here, much stronger numbers. Procter and Gamble is obviously doing quite well on a return on equity basis right now. Again, they jump out at me all the time. Monster Beverage actually does quite well. Hershey, do I see it here? The operating margin. Here's the ROE. The ROE is pretty impressive for Hershey, actually. Really impressive. So on to the next one. Price, earnings, and surprise charts at Zacks are critical. Give us a quick look. These are again, by the number of analysts covering stocks. We're looking at these different names. What we'd like to see is right here. That's the Monster Beverage chart. Really nice. Or right here, the Procter & Gamble chart. When you get stuff like this, that is not what you're looking for. Also over here, you got Hershey kind of leaning down in its earnings estimates, and you can see that really took the stock down. That's kind of key. When the market saw that decline in estimates, and it sold off big time. Here's another example. CTVA sold off when those estimates, typically when you see that sell off, 6 to 8 months later, the estimates are going to come down and they're going to catch up. Basic problem here is their markets sometimes when they start selling off, they see these turns. But in these charts, you can see exactly that here and here is what you want. That's certainly not what you want. And these are, exhibit A of when you can watch a stock sell off and get out of the way because the estimate revisions are going to get cut. Here's some more charts. Again, quickly, Chewy, big upgrade. We'd have to look at his analyst report to know what's going on here. New York Times actually doing quite well in the post-COVID environment. Keep that in mind. It's a publishing company. You probably think, oh no, publishing company, but they're doing well. Mondelez, like I said, is there earnings strength here? That is another nice chart. Over here, Restoration Hardware is obviously one of those COVID bubble stocks. There's no evidence that Restoration Hardware is on its way back right now. It could be in the future, but not right now. So, net margin on this line for these stocks, total debt to capital on this line, capex to depreciation on this line. Obviously, this line would be the best for studying, and over here looks like we have the best charts for this too. Return on capital here, price to sales ratios, that's a valuation measure, and dividend yield to tenure if you're an income investor. Stable stocks will obviously dividend yield to tenure are critical. You'd like to see this one high, if not low, if you're going to be a dividend investor. I'm not picking momentum or growth or value or income investing for you. That's your job. These slides are going to help you once you identify what type of investor you are. All right, so last but not least, by any means, largest 1 month change, current fiscal year earnings estimates. This is what is one of the four and probably the most important of the four elements of the Zacks Rank. So, first of all, top consumer stocks, price to free cash flow, enterprise value to sales, and cash flow yield for these names. Again, I would focus mainly on the numbers, not the charts, because it's kind of noisy here. But you can get some very interesting understanding of what's going on here. Elf Beauty, of course, on a price to free cash flow basis is certainly a growth stock. You can see how it's high priced it is, and these ones are obviously not. So keep that in mind. Different area, we're going to get a lot more growth stocks and using this screening metric. Earnings, total liabilities, and a quick ratio. Kind of interesting for perspective of understanding these stocks and companies. And here's their percentage change in estimate revisions over time. And again, you'd like to see something positive over time that's just continuously moving up over the last 6 years. You'd like to see this be pretty good and pretty strong. Here, the New York Times we talked about, you can see after COVID, it's definitely gotten a lot stronger, and they had some down periods with up periods during this whole run, but now it's relatively speaking the better name in the better space. UNFI is actually one we need to look into. Like we said, they had a big beat. We'd have to go look in their earnings story to figure out why that has happened, and it looks so much better. Standard deviation of changes in estimates. So this is the volatility measure of these things. Again, down here I've got the New York Times. It's not that volatile, actually. It's very low. Philip Morris actually fairly high. So interesting stuff. I would focus mainly on the 3 months percent change chart over the standard deviation chart. Okay, that's it for me. Thank you for attending. Here's where you can get the slides. They're obviously critical for picking stocks, using this information. I highly recommend calling us, 866-794-6065. Send us an email, strategycall@zackspro.com, or find us on the web at www.zackspro.com. I'll repeat these one more time before I exit this YouTube session, 866-794-6065. Strategy call at zackspro.com or on the web at www.zackspro.com. Thank you much for your time.